In two relatively short videos, I want to walk you through the Advocate's investment philosophy, and this is really centered around number one, why is investing so hard? That's going to be the first part. The second part, though, is then what do the advocates do about it? So roller coasters are fun for the thrill that they offer. Unfortunately, investing also feels like a roller coaster, but instead of fun, it's a roller coaster of emotions. And emotional roller coasters are not fun. In fact, investing often causes significant stress in people's lives. And they live and invest at the mercy of the news, the markets, and their own emotions. So, why is investing so difficult? Well, there are actually a number of reasons, but they all stem from the same cause, and that's us. That is, people. We're emotional creatures. We care what others think about us, and frankly, that makes us awful at investing. We bring all of our emotions, our biases, our cares, and human behavior into the investing world, and the outcome is not pretty. We end up with a stomach churning ride that's not nearly as fun as a real roller coaster, but worse, it can have devastating consequences for your life. So, we're going to touch on a few of those causes that make investing so hard, but not all of them, because frankly, there's just not enough time. 400-page books have been written about this topic for good reason. We'll also talk about the advocate's solution to the problem and why that solution serves to cure not one, but all of our problems as investors. Investing is hard because unfortunately our emotions surrounding rise and fall with our portfolio. And what do I mean by that? Well, let's take a look. So this is what we call the emotional roller coaster investing, and stay with me as I walk you through what you've likely felt, if hopefully not acted upon, during a stock market cycle. It starts with you having some money invested in the market, let's say $1 million theoretically. And as that money grows and you make 50,000, then 100,000, you feel optimistic, then excited. It grows to 250,000 of gains, then 600,000, and it feels euphoric. Like, I can't lose. This is where investing feels really, really good. And unfortunately, it also feels really, really easy. You're up 60%. Why not buy more? However, this is also the point of maximum risk. You've now added to your stock investments or perhaps bought some of those high-flying growth stocks. However, when investing feels the best, it also happens to directly reflect the worst time to be invested. In investing, good feelings equal risk. Just as the market begins to rightly correct, first a bit of anxiousness sets in. This is where denial comes in. This correction's short, I'll weather it, like I know I should. I mean, these things happen, right? However, soon that denial can turn to fear, desperation, and eventually panic, as your $1.6 million savings is now cut in half. Just think back to November 2008 or in March 2020, and you'll know exactly how this feels. Finally, you just had enough. I've got to sell some, if not everything. I cannot stand to lose anymore. I'll never get back to break even. This is what I'd call capitulation. I give in. I give up hope. The market falls even further. Well, at least I was right. At or near the bottom is when it feels the worst. It's beyond panic at this point. It's just giving up hope. Let's just forget it. Investing never works out. This is actually the point of maximum opportunity. This is when the stock market is at its cheapest and offers the most upside. When your emotions hit their low point, you probably have a once-in-a-lifetime opportunity to invest. Finally, the market does rebound, as does hope, which again turns to relief and finally back to optimism. Congratulations. Now, you've ridden the emotional roller coaster of investing and you've hated every single minute of it. And hopefully you've stayed on for the whole ride. So emotions are probably our biggest enemy when it comes to investing, but there are other factors that make investing difficult. It's also hard because as investors, we bring all sorts of biases, mental shortcuts, they're called heuristics, and all sorts of other things into our portfolio. And often these are helpful in other aspects of life, but not so when it comes to investing. And what do I mean by that? Well, let's take a look. So this circle represents the entire world stock market, 100% of it. That is, if you take the dollar, value of every single country's stock market, and you add them all up, this is what you get. This is your investable universe, if you will, 100%. Now let's take a look at what the average investor around the world actually invests in. And let's start with the US, since this is probably your case. So this circle that just came in means the average investor who lives in the United States has about 81% of their money invested in the United States. We tend to buy what we think we know. But is this a good strategy? Is it a reasonable strategy? This last circle that just came in represents how much of the USA you would own if you just stuck with one simple rule. The USA makes up just over 50% of the world's stock market, so it would make sense to have just over 50% of your portfolio in the US and the other 50% of your portfolio outside the US. However, as Americans, we have over 80% invested in the US instead of 50%. Why? Well, because I previously said we're biased, and it's something called home country biases, and this is just one bias. There are lots of others. Maybe this is particular to the US, though, because after all, we are the largest economy in the world, and we have the largest stock market by a wide margin, right? So let's take a look at UK investors. Again, this represents the size of all stock markets around the world combined. Well, unlike US investors that have over 80% invested at home, that is in the US, UK investors have only 63% invested at home, that is in the UK stock market. However, if you think we in the United States are biased towards investing at home, we have nothing on our UK friends. The UK market makes up only 5% of the world's stock market, and yet they have over 60% invested at home. That's 12 times what they should if they weren't biased towards investing in what they think that they know. Finally, let's talk about the Australians. Australians have over 80% of their money invested in Australian stocks, even more than US investors have in the US. And get this, the Australian market makes up only 2% of the world's stock market, meaning Australians have 40 times more invested at home in Australia than they should, were they not biased towards their home country, Australia. And this is simply one example of a bias playing itself out in investing. There are literally hundreds of others, and none of them help us make us better investors. We use these biases and shortcuts because investing is emotionally difficult, and this helps us cope, but it doesn't work. Another common perception is hindsight bias, which leads an investor to believe after the fact that the onset of a past event was predictable and completely obvious, whereas in fact the event could not have even been reasonably predicted. So the result, bad experiences. The result is that investing is painful and it's difficult. It's emotionally taxing, and unfortunately these bad experiences lead to even worse outcomes. Not just worse outcomes, these are horrific outcomes that fundamentally change people's lives in the way that they actually live on a day-to-day basis. And so this is scary because this is real. This is what actually happens to people. A 2016 study by Dalbar confirms these bad outcomes. And what makes it scary is it's tracking real investors and their stock portfolios versus what they should have made and what they did make. And so Dalbar looked at the real returns actual investors made over the trailing 12 months, 5 years, 20 years, and 30 years. And they did it by tracking those investors putting money into and taking money out of stock mutual funds. The results showed that the average actual investor made 3.98% per year from 1986 to 2016 on their stock investments. In the meantime, the U.S. stock market itself returned 10.16% per year over the same period. The difference? Investors tended to load up on stocks at that point of maximum risk that we talked about, and they withdrew money from stocks at the point of maximum opportunity. So think back to our roller coaster on that. And this 3.98% versus 10.16% is what we call the behavior gap. That investor turned $100,000 in 1986 into $322,000, and they should have turned it into $1.82 million. That investor got to retire on $15,000 a year, and their standard of living should have been $85,000 a year. Now that's scary because it's real. So in the next episode, we're going to talk about, so what do the advocates do about this problem?